welcome back to The Price of Business. I'm your host, Kevin Price, talking to you about you and your business. You know that song. That means Bob Loeser is in the house. Taxman Bob, as we affectionately call him here on The Price of Business, coming in, giving us his insight, what's happening on the business and tax front. And there's always something happening, isn't there, Bob?
Yes, there is, and it's the aftermath of April 15th, thank goodness.
Yes, I still see certain lingering tax forms hanging off of your body.
Those are actually the staples that haven't been removed yet.
Haven't been removed. Yeah, I can imagine. I just, you guys must be a little bit of excitement addicts, a little bit adrenaline addicts, CPAs.
You get to a point. I mean, interesting, and a lot of firms do this here in town and across the country. We'll have a cutoff date. The cutoff date for us was the 5th, Friday the 5th of April, where basically we told people that if you didn't have it in by the 5th, or maybe Saturday morning the 6th, that we weren't going to promise getting your work done. Mm-hmm. Then we cut it off.
Unless you wrote us a ridiculously large check.
Right. Or you're right. Or they wanted, again, to us, not to the IRS.
Right, to you, exactly. Exactly.
But, the bottom line comes to that, we've got to file extensions, and it isn't a matter of just running it through your computer. You've got to make a good guesstimate as to what Kevin Price and his wife made last year, what withholdings they had, et cetera, and do they owe or they have money coming back. I mean, if you show that you're getting a refund back, and you really owe $40,000, they could actually deny the extension, all right, and possibly get you for negligence.
Right.
Now, there's nothing wrong with sending an extension and saying that you owe $10,000 and you don't have the money to pay. They may agree to the extension.
They'll likely work out the payments.
Right.
You're going to be paying extra.
Right, but they might deny you the extension. I had somebody on Monday call and say, hey, here's my W-2. I know you told me to pay some money January 15th to cover this. I didn't. How much do I owe? I said $85,000. He said, how much should I pay? I said, at least $25,000 to secure it. And he goes, what if I pay nothing? I said, you'll probably be denied the extension. Then you will owe penalty, interest, and then penalty for not having an extension. Yeah. I said, by the time it's said and done on $85,000, it could be ballpark about $12,000 in penalties.
But the good news is you could be Wesley Snipes' roommate.
Correct.
So tell me a little bit about how it went. First of all, what was it? Pretty similar numbered in terms of people who chose to go the extension route, or was there more than usual?
I think I actually think there was less than usual. I think people did wait a little bit longer to get the returns filed, but we actually. Cutting off that date at April 5th, we actually, everything that came in, we tried to get out. Now, again, we bumped up the bill, $50 here, $50 there, if they really wanted to file by April 15th. But the bottom line is the people that filed extensions are the ones that are, generally annually procrastinating and or probably have some refunds coming back, which in my opinion is idiotic, because if you've got a refund coming back, why wait any longer to get your refund?
Why let the federal government accumulate that interest?
Right.
Yeah.
The ones that...
thank you very much, but yeah, good luck with that.
Right. But the ones that owed, for the most part, either paid or paid with extension, and they know they owe. I had a doctor group that sold out a percentage of their rights, and everybody got a big chunk, and they had to cut a $100,000 check a piece on January 15th to make sure that there was no penalties. And so we did a lot of the estimates for them, April 12th or whatever, to make sure that they were covered, and for the most part they were covered. Interestingly, we've talked about what they call alternative minimum tax, which is for the most part a tax that says that if you're not at a 22-point-something% tax rate, we push you up to that because you're either making too much or you've got excessive deductions in like property taxes, charitable, things of that nature.
You got to make up for that.
I'm pleasantly surprised that several of them are either big earners or the doctors that had the sale of their partnership interests did not kick in alternative minimum tax. We had actually planned for...
And that's automatic?
Correct. Normally it is automatic.
You reach a certain threshold and you get hit with it.
Right. But at a point, you're pushed, like capital gains is very important at 15%. This year, 2013, it's at 20%, plus that investment penalty of 3.8%. So you're paying this year in 2013 23.8% on the sale of your long-term capital gains. Well, again, we took advantage for this doctor group that 15% was the tax rate. I purposely added in 5% with the thought that, all right, alternative minimum tax is going to kick in. And for these docs, because the sale was so big, it didn't kick in.
So did you see much weeping and gnashing of teeth?
No, fortunately not.
Yeah. So, people, what do you think was the reason for that? Resignation? This is just the way it is?
I think for a lot of our clients, we prep them to what to expect
since late last year. Probably.
Correct. I mean, what to expect. So what am I going to be? Now, I had a couple pleasant surprises. That again, I had a client that we did some planning. We had talked about it. That take advantage of the 15% long-term capital gains rules last year. Took advantage of it. One of my clients sold back to his company $1.2 million worth of the shares of his stock. All right. We thought it was going to be at 20%. It was at 15%. He ended up getting a $32,000 refund on Monday.
Sweet.
All right. And he was happier than happy. I mean, he said, if it wasn't, I'd hug you. I said, no, thank you. A handshake will do.
Yeah, absolutely. Taxman Bob is what we call him. You can learn more about him by emailing taxmanbob@pdq.net. That's taxmanbob@pdq.net. So, what's happening as far as timelines?
We've got, of course, April 15th is done. The next one is September 15th, or actually October 15th. No, I'm right. I'm sorry. September 15th for corporate extensions, October 15th for personal extensions. Okay. You also have the franchise tax reports that if you haven't filed and there's tax due is due by May 15th without any penalty or interest. If you wait past that date, you can extend, but if you don't pay the tax, then you're going to owe 0.5% a month in penalty plus another roughly.
And let me tell you, that adds up fast.
0.5% in interest. So, we got our tax program software prints out the Texas franchise report at the same time we do the corporate return. So I hand them to them March 1st. So they know 2.5 months in advance what they do or don't owe with that franchise. Now, normally that franchise, if sales at your business are less than $1,030,000 this year, then there is no tax, but you do have to file.
So I have to file.
All right. But if you're over that, then it's based upon either a manufacturing deduction, it's gross less manufacturing cost, or it's service production, which is gross less employee wages and employee benefits. You don't get benefit deductions for rent, office supplies, utilities, telephone, etc. So whether you're downtown and you have a $10,000 a month overhead, or you're in the burbs and you have a $3,500 a month overhead, you don't get any additional deductions for being downtown on the franchise tax.
Yep. One and only Bob Loeser. We call him Taxman Bob around here. taxmanbob@pdq.net. That's taxmanbob@pdq.net. Next time we get you on the show, because it's hard to believe we're already in the second quarter.
I know.
But when we get you back on, because you've now had a good chance to assess how people planned for April 15th.
Right.
I'd like to do kind of an inventory of what people can do next time to do a better job.
Okay.
So let's think about that next time. Any closing thoughts before we let you go?
No, I think you should. I realize it's only April, but all of you out there need to start planning ahead for 2013. You say, well, what's the big difference with whatever? Well, you'll notice if you're an employee and working for someone that your check is a little bit smaller. That's, of course, because Social Security is now back at 6.2% rather than the 4.2 it had been for 2 years. Wasn't a part of the new bill that was passed, the Cliff bill, in December. Second thing is, each of you out there is going to pay more tax, whether you're making $40,000 a year or you're making $240,000 a year. They're just telling people that the rich are going to get hit. Don't be fooled. Everyone's going to get hit. The rich are going to get hit more, but you're going to get hit, which could mean as little as $30 a month. That's $360 a year, and it could mean $75 a month, which is $900 a year.
Yep.
So it's real important you start doing your planning now, that you make decisions like selling a piece of land that the family has had in stock for 15, 20 years. You're going to pay the 20% long-term capital gain, and you're going to pay that investment tax penalty that the dear president put into play for another 3.8%. So you're nearly talking 25% tax.
Unbelievable. And so prior preparation prevents poor performance. So I would encourage you to contact Bob. The phone number?
713-953-1272.
One more time?
713-953-1272. I think that was an 18-wheeler heading our way.
Here you go. Bob Loeser. Make sure you talk to him, learn more about him. We always enjoy having him here on The Price of Business.
There's one for you, 19 for me. 'Cause I'm the tax man.